Guys, John Polemy here, Actionable Intelligence. Today is Saturday, August 30th, and this is the weekly market update. The disclaimer, anything that you hear or see on this video or podcast is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, before I get started, just want to remind people of a couple things. We do have the Actionable Intelligence Alert group, Facebook group available. It's free. You will find links to it in the show notes. You can go there. A lot of the charts, a lot of the slides that you see on here, I go through them pretty quick and I post quite a few of them there. I also post things during the week. And as this Facebook group has grown, we're getting other people now beginning to post things. So it's actually pretty good, pretty valuable, interesting. So if you're interested in that, it's free. Facebook, uh, Actionable Intelligence Alert group for the weekly videos, and check that out. We also, for those of you that were interested in the reality checks, that's back up and running on Rumble and Bitchute. I upload those. There are links for those in the show notes. That's my political and sociological commentary, if you will, what's going on, my editorials. So you can go there and check those out. The links are in the show notes. We also have the Actionable Intelligence Alert free weekly newsletter that comes out. That's where I curate all of the videos, articles, podcasts, whatever that I'm looking at for the previous week that I found interesting. And sometimes in there, I'll actually expand upon how it applies to the subjects we're talking about in these videos. And of course, we have the Actionable Intelligence Alert paid product, which is the model portfolio. It's how I'm investing my money. So far, we've been doing fairly well with that portfolio. It's actually, for the last 4 or 5 years, has actually overall beat the S&P. So if you're going to be an active investor, most active investors can't beat the market. So far, we've been able to do that, fortunately. Of course, previous performance is no guarantee of future performance. So if you're interested in those things, all of the links are in the show notes below. Please take advantage of that. Okay, let's get started. So we had a big announcement, I think, from Cameco this week, basically saying that there's going to be development delays at McArthur River, the project, which is kind of a complicated mining project, but basically says Cameco says delays at mine to affect 2025 production forecast. Cameco says development delays in transitioning the McArthur River mine to new mining areas are expected to affect the 2025 production forecast. Production from the McArthur River Key Lake operation is now seen at 14 to 15 million pounds of uranium concentrate in 2025, down from the previous forecast of 18 million pounds. The company's share of that production is now seen at 9.8 to 10.5 million pounds versus 12.6 million pounds previously. Cameco says it may be able to partially offset that reduction with increased production from the Cigar Lake mine. And I put here at the title slide, does anyone know how to play this game? So now we even have the two largest uranium producers in the world struggling. And we've cataloged and discussed in the past all of the companies that were bringing on the old brownfield projects and how they've all struggled. And so I kind of put this quote up here from like Casey Stengel, who was the manager of the expansion. I think it was 1962 Mets. And I think the guys made like 4 or 5 errors in one inning when they were in the field. And when they came in, the manager, Casey Stengel, looked up and down the bench and says, does anyone know how to play this game? So it's kind of the same question here. It's like, this is like super bullish news. Demand is increasing. Nuclear power is totally flip-flopped as far as it's being acceptable again. It's being built out, and yet we don't have enough uranium, and we don't have the ability of these mining companies to evidently ramp production. It's actually quite disconcerting. It's actually quite bullish also. This is why I continue to maintain that until we see some really billions of dollars of investment come in and a whole bunch of getting people trained up, which is going to take years, we're just going to be in danger of not being able to supply enough uranium. Um, one of the things that was noted was qualified people. Again, we're back to that again. Because this was a generational gap in this industry, people left the industry. People weren't able to pass down their knowledge to the next generation. And so now you have a shortage of qualified people, and this is affecting operations. The other thing to remember about McArthur River is it's a very complicated system to mine. They have to freeze the rock because of the water that comes in. Remember that something that precipitated the last bull market in uranium was the flooding, at Cigar Lake, I believe, was the mine. And so McArthur River, they have to freeze the rock before they can go into these areas. Otherwise, the mines will be inundated with water. So it's very complicated. You have to know what you're doing, and it's hard to do. And so you run into issues. And so it does affect production. So anyway, even when you have the top two producers now basically suggesting that their production is not going to be as high as they originally forecasted, this is going to be a problem for the industry, but it'll be good for prices. So this was also another article. It said Cameco Corporation reduced its 2025 uranium production forecast due to development delays at McArthur River in Saskatchewan. Went over how much it's going to produce. The company cited development delays and slower than anticipated ground freezing as the mine transitions to two new mining areas. Additional factors include access to skilled labor and timing of commissioning new equipment. They said that the Cigar Lake mine continues to perform well and may partially offset the McArthur River shortfall by up to 1 million pounds. The Cigar Lake operation maintains its 2025 production target of 18 million pounds, with Cameco's share of 9.8 million pounds. The company stated it can meet delivery commitments through various supply sources, including spot market purchases, inventory use, borrowing product, and advancing long-term purchases. So, yeah, we can move the shells around a little bit, but inevitably you're going to have to produce more uranium. And I'm seeing this is becoming more and more difficult. I haven't seen no, there's not one mining company I don't think that has not had a problem. So this was BMO Capital Markets take. Basically, um, they raised their target for Cameco. It says basically says what we said, says while EBITDA changes are limited, fiscal year 25 down 3%, Cameco is now likely to purchase more uranium from third parties, impacting free cash flow a touch -5%. However, perhaps more significantly, the supply deficit increases, which is likely to have a positive impact to uranium pricing, particularly heading into the World Nuclear Symposium next week. It could be the positive catalyst needed for increased contracting with another leg up in sentiment. So, yeah, we have the World Nuclear Association meeting in London next week, and this is the news right before you go into that. So I don't think this was like Cameco doing this deliberately. I just think that this is what happened, and it happened to come out. So it could be a positive catalyst. Uh, under contracting for uranium is a situation the fuel buyers are in, and so we'll see what happens coming out of these meetings and what is reported out of there with the folks that go there. So to my mind, it's actually bullish ultimately. This is why I think you can't go wrong just buying physical uranium. Um, you'd have no mining risk then, or buying companies that have big stocks of uranium on their balance sheet probably is not a bad idea. And so this is what I see as a problem, and I think it's an opportunity. He also says U.S. imports almost all of its uranium. And here's a chart from the U.S. Energy Information Administration. It shows back to 1950, the domestic production and the imports of uranium. Since basically the mid 90s, or beginning of the 90s, we've imported most of our uranium. And this is interesting because, you know, 20% of our base load electricity is nuclear in the United States. And so I think that the the Trump administration is going to recognize this. This was on uranium was on the I don't think uranium was on the critical minerals list, if I recall. I can't remember. But I do think that it's very possible this is going to get recognized, and then you could see something similar to what you saw in with rare earth metals, where the government steps up and puts a price floor on uranium, trying to stimulate more domestic uranium production. I did see that there was a project that was kind of fast-tracked, a uranium project that's permitting. So the things that they put in place because of the executive order um, were were are starting to see fruition with the quicker pace of permitting. So it's all good and fine to build a bunch of SMRs, but we need the fuel to supply them. We need the enrichment capacity. We need the infrastructure. And you can see that basically for an entire generation plus, we've basically, even since the late 2010s, we basically don't even have a mining industry in the US. We just imported all of this because, that was the easiest thing to do. And that was globalism, right? We just comparative advantage. We just buy all of our stuff from the Russians. Then, the thing happens in Ukraine, then everybody says, well, we're just going to stop doing business with the Russians. Okay, well, where are you going to get your uranium? Because your uranium industry here in the United States basically died, and you're trying to bring it back from the dead now. And that's going to take a lot of time, a lot of effort, and a lot of money. And so at some point, I think the US government is likely to step in, which could be a also catalyst for US mining companies, US uranium miners. Very easy for them to say, we're going to put a floor under it and buy so much, your US uranium per year, make it 120, 100, $120 a pound. I think that would stimulate a lot of investment into domestic uranium mining. So the price of uranium moved up yesterday. Sprott, the NAV went positive. So this is from John Quake. The Sprott Uranium Trust issued 1.361 million shares to raise 25 million, ready to stack more uranium as its NAV rose 107 million to 5.29 billion, but now holds $68.8 million in cash uh, available to buy more uranium. So I expect they have been buying a little bit. I saw a couple deals in the last couple weeks. So again, they're still active, and I expect more of this as if the uranium price starts moving up in the NAV, you have the at the market, or they have the mechanism to issue more shares to buy more uranium. So again, this is always in the background, kind of that buying is there, trying to soak up all that excess uranium that's whatever's left, what inventories are left. And now you have possibly Cameco coming into the market to supplement its lack of being able to, mine at McArthur River. You see the prices moved up for September up to like 75, 75 to 77 bid ask, I guess. Um, I expect the uranium price is going to go higher over time. Some people are saying it'll be $100 by the end of the year. I don't make price predictions. It's impossible to do that. But definitely the impetus and the push is higher in my view based on this news. It's just, we're going to get to a breaking point where these utilities are going to come and start contracting, and like they're going to have to get nervous now. I'm contracting with you, but can you actually deliver this uranium? This is every single miner is having issues, it seems. So you have to be very careful. And what about these smaller miners? A lot of them said they were going to deliver uranium, like Peninsula, and then they weren't able to do it. And so then you have to go get the uranium somewhere else. So what's the deal? Can you really do this? So I want to talk about gold. A lot of people are bullish on gold. We had this ascending triangle. We had this move upwards back in April, close to 3,500. Then we had the pullback. We basically went sideways till recently. And you have these are typically, you know, in technical analysis, when these things get down to these triangles, they either when they typically break higher, they usually follow whatever the previous direction. So we were moving higher and now take this break, as things get digested, and then we just have moved higher here. So, um, yes, gold is, I think, in a unique situation that we can't just say, well, it's overbought. I'm not trying to make excuses here or be a pumper, but with the central banks just kind of buying like they are and being so active, they're kind of price insensitive. They just want to get a certain amount of gold on their books, especially as they kind of move to that as their reserve asset away from U.S. Treasuries as more and more do that. And so I think that this is positive. Obviously, the gold miners are going to benefit there. I think they're starting to wake up. We'll show that later. That kind of broke out too, the GDX. But yeah, I wouldn't just necessarily discount this and say, well, it's overbought. There are people calling for we basically did have our consolidation right here, and now we've broken higher and a continuation higher. How much higher can it go? I don't know. Could this be a false breakout? Yes. Could I be wrong? Anything can happen. But typically, if you were playing the odds, this is a continuation of the bull market for the next leg higher. And so, could you go to 3,500? Could you go to 4,000? Ultimately, it's all within the realm of possibility, especially considering the fact now that the United States is definitely going to be entering a rate cutting cycle. It's pretty much baked in that we're going to start cutting rates and rates are going to start moving lower. We're the last major G7, G20 country to cut rates. And so, that's a whole other discussion around the economy, which I'm not going to get into, but that should be positive for gold. That should be positive for emerging markets. It should be positive for commodities in general because cutting uh, rates will move down relative to rates in other countries, and this should also weaken the dollar. So, all things pointing to positive framework for gold moving higher over the ensuing months. So I wanted to talk about this. This is an excellent chart. This is the GDXJ, the junior gold miners, 12 years, basically range bound, and then uh, popping higher. So this is pretty positive. A lot of the stocks have moved. The GDX is up pretty significantly already this year. As you see, or since 2024, it's kind of moved higher. But when you move above something like this, I'm not saying that race out on Monday and buy the GDXJ. I have a position. Um, and just for, let me clarify something. So I'm a generalist investor, okay? And so I'm not going to turn the AIA newsletter into a gold junior newsletter. Gold juniors are it's a very specialized field. You really have to know what you're doing. And so I don't advocate unless you're going to go out and just devote a lot of time and get a basket of these things. Um, I wouldn't recommend just buying one or two. It's kind of like venture capital, right? Because a lot of these mines are single mine companies. A lot of them are come bets. You're betting that the price of gold is going to go higher and that they're going to meet their production goals. As we know, mining is hard. And so I think the way to play this for most people, unless you're going to subscribe to a bunch of gold junior newsletters or do work yourself, is to take advantage of this breakout and what I think is a multi-year move higher, is to just buy the GDXJ, and I think you'll do well. You could also do the research if that's what you want to do. You can spend a lot of time trying to figure out which companies are going to be the winners. But again, a lot of times these companies are one mine company. They are, it's just a lot of work. and it's very difficult. You really have to specialize, and unless you have the time to do that in the experience and the knowledge, you're probably better off. Again, I'm a generalist investor. I'm bullish on gold. I hold physical gold in a private vault off not at my house, and I do own uh, the ETF, and I do own certain gold stocks, but I kind of stick with, I started out owning one of the majors, Anglo Gold, which I've talked about publicly. It's done fairly well. And I think if you just bought for the average person, if you didn't want to buy the GDXJ, if you just went out and bought even though they're up quite a bit, I still think they're going to do very well, especially if oil prices stay low. Um, just buy, an equal amount of Newmont, Agnico Eagle, Anglo Gold, and I don't know what Dundee or something like that, and you probably do well, right? I'm not advocating you do that, but what I'm trying to tell you is as a generalist, you know, we're just trying to catch the major trends. We're not trying to get too crazy with this. And like I said, I can very easily turn the um, turn the Actionable Intelligence Alert newsletter into a gold newsletter, junior newsletter. I don't want to do that. There's a lot of opportunities, and we don't, I diversify, and I just don't have the experience, time, or inclination to, study all these juniors and try to figure out which one's going to be the next move higher. I think royalties are a good thing to look at if you're just looking to put money to work. Um, U.S. Global Investors, Frank Trotter's outfit, I think it's his name. They have a pretty good, decent. It's called. They have a gold mutual fund that basically they has a lot of royalties in it. That also does things based, I think, on cash flow. It kind of re-rates things based on cash or production. So you might want to take a look at that. So there's other opportunities, but again, diving into the world of Vancouver Stock Exchange and over the counter market, this is you can strike it rich for sure, but you can lose a lot of money too. And I know from experience. So be very careful. Um, and there's a lot of, uh, shall we say, quick buck operators in the junior mining sector. And it is mining. So there's no guarantees as we've seen. Going back here too, also the silver ETF is broken out too. And I think it's SILJ. And you might want to take a look at that also, because I think silver, as we've said before, typically what happens, gold moves higher first, gold stocks, and then silver plays catch up. But when it does, it's like a volcanic eruption. It just goes straight up like a moonshot. So I still think there's opportunity there. Um, I'll probably just have a short article. I own a couple silver stocks, but they're not like I don't think I just think that one's kind of well known, one's kind of off the board. I probably won't put them in the portfolio, but I'll let the subscribers know what they are. I'll probably write an article tomorrow, short article, and just give a few blurbs of why I own them, because I wanted some position in them. So I'll let folks know what I'm doing, but likely won't put them in the portfolio. The portfolio is kind of trying to look for more longer term. These things are too volatile, but I think that if people have a desire to see what I'm kind of doing, this is what I'm doing in my personal portfolio, I'll list that. So this is from Ronnie Stoffel, who does the Incrementum uh, outfit about gold and gold we trust. This is a chart that was he put up on Twitter, basically to mean revert back to its long-term average of 1.14. This is the S&P 500 to gold ratio from basically 1900 to August 2025, 120 years of mean reversion. In order to get back to the long-term average, which is 1.4, gold price would need to triple from here. So is that going to happen? I don't know. I'm just telling you that based on previous instances when we've had pretty decent rallies because the S&P, the gold ratio has returned to its mean We have a situation where the S&P 500 it was extremely overvalued relative to gold, and now it's mean reverting. It appears to be mean reverting. We've seen uh, that this has happened in the past in major moves. The gold price would have to triple from here. I definitely think gold's in the next several years is probably going to be substantially higher. By the end of the decade, 10,000 isn't out of the range of possibility. I mean, it just depends the amount of currency depreciation that these governments are going to be forced into and all the other things that are going on. I mean, I'll get into it later on in this slide deck, but we have three major economies in Europe that are facing, financial distress to the point where two of them may need IMF bailouts, which is a whole nother can of worms. So this is from Tavi Costa. Foreign central banks hold more gold than treasury. So this is something that's happened recently. This is the first time since 1996 you have gold holdings as a percent of foreign reserves are now higher than treasury securities. And that makes sense. We've talked about why this is in the past. The US is just going down a road that makes it less desirable to hold its treasuries and hold its currency as a means of savings, as a store of wealth, because they're debasing the dollar. They're they have no intention of even slowing down the debt creation. There's no constituency for it. People can see this. People in the United States seem to be aloof to this, or seem to be not paying attention. But other foreign central banks do pay attention, and other governments pay attention, and they're like, wait a minute, these people are out of control. They're looking at $100 billion in Social Security and Medicare unfunded liabilities, plus all the other issues, plus the 37 trillion in debt, plus the $2 trillion a year deficits being added to the debt. Yeah, let me get out of this, because they see that the pernicious nature of this spending and fiscal irresponsibility, and, it's like this all leads down to one road, you know, inflation and money creation, money printing. So gold, inflation is not price rises. Inflation is a debasement of the currency, a manifestation of that currency creation, and then inflation is higher prices. And people get that confused, I think, deliberately. I go back to what I said before. It's instructive when you watch all of these people, and I do feel for them. They were lied to, they were misled. All these people that are in all this debt, college debt, tuition debt. Um, we can be callous and say, well, they didn't know what they were doing, but they were sold. The establishment sold them. They sold them the dream, sold them uh, you know, the idea that you go into debt for college, that gets you a ticket to corporate America. You get a job in the American dream. Well, that's stupid. Things have changed. And so now we have, all this debt, student debt. We have all kinds of debt, and it's out of control. And the whole society, um, we have a situation where we have a K-type economy where if you have wealth, you're doing fine, well, and if you don't, you're going to be living as a Russian serf, living hand to mouth under a lot of distress. And I think this is eventually going to lead to political reactions. But nevertheless, people outside the country see that, what's going on. You could see what's happening here. This is all since basically um, the Russian-Ukrainian war, the reaction of the West and the United States in particular to that, where we've just went around and confiscated another, you know, basically nuclear powers, $300 billion in asset. People are like, no, I'm not going to hold these treasuries, because it was happening well before that, because the fiscal irresponsibility and the debts, it's now getting into the runaway phase. And I think you're going to see more of this. You see at one point back in the 1980, late 70s, early 80s, when we had um, foreign central banks had almost 75% of their reserve assets in gold. Are we going to get back to that? I don't know. Can we get back to 40 or 35 to 45%? Absolutely. I think we're heading there. And that's why I think there's going to be a constant bid under gold. So here's another example, another anecdote, if you will. It's not going to move the needle, but this is what you're seeing more of. It says Thailand adds gold to pension fund. Thailand's $45 billion fund sees gold equities boosting returns. Thailand's government pension fund expects gold, commodities, and a rallying global equities to drive a recovery in its returns after a dismal performance in the first half of the year. The fund has added to its holdings of gold and commodities as a bet the U.S. trade tariffs and increased geopolitical tension will fuel demand for haven assets. The fund aims for an annual return of more than 3% in 2025 after earning 1.19% in the January-June period. And so I've seen other things. We've seen where the Chinese have allowed Chinese insurance companies and encouraged them to buy more gold. We're going to see more of this. Okay, we're going to see savings move out of paper currencies as people lose trust into safe haven hard assets. I like how they say it here. It says, uh, even Bloomberg says, as a bet, the U.S. trade tariffs and increased geopolitical tension will fuel demand for haven assets. Yeah, that's what's happening. And it's not just because of tariffs and it's because and geopolitical tensions because of the whole West is imploding on debt. It's happening. It's happening in slow speed. It's happening slowly, and then it will happen all at once. So again, I'm still bullish on oil. A lot of people aren't. This is the WTI net long positions. Bullish bets on oil are at 17-year lows. That means everybody's pessimistic on the oil price. I get the arguments of why they're pessimistic. I'm not going to get into an argument about it, but when you're this pessimistic about oil, you're basically at the lows of during the great financial crisis. Okay, when we had an actual financial crisis. So does this mean we're heading into a financial crisis equal to or greater than the GFC? It's possible, I guess. Um, but I just think that people have overestimated things or underestimated demand and overestimated supply. And I think that's going to become more evident as we move forward. And especially if there's going to be more money creation, more currency debasement. I mean, this is going to be helpful. As a lower dollar, this is going to be helpful for oil prices. And again, getting into the geological situation, there was another excellent article in the Goring and Rosenzweig Q2 report that they came out with. Every quarter they do their review or report, and I suggest you read it. You can download it for free from their website, but there's a long discussion about the whole situation around U.S. shale and has it in fact plateaued? And I think there's a convincing argument being made that it has. Now, somebody will point out, well, in June, U.S. oil production was higher. Yeah, but if you look at the shales, they're actually plateauing. I think a lot of that, if you look at it closely, my understanding is that the reason you had increased production because they include offshore oil. We need to focus on what's going on in these shales, in particular in the Permian. Okay. Um, and part of the discussion that's in the Goring and Rosenzweig piece is the whole discussion around efficiency and, uh, you know, less rigs, but they're more efficient and things like that. And they kind of talk about that and show the data on that. It's not what people think. It's actually they're becoming less productive. And we know from listening to like TPL and Landbridge that the water cuts, the water that their water business is exploding in the Permian because as you get less oil, as production starts to decrease, start getting more gas and more water. And so this is why those water businesses for TPL and Landbridge are exploding to the upside. So there's a lot of clues out there. It just depends, I think, on what you want to see. You can find information. You can find whatever you want to find as far in the data, but I'm a contrarian, and I can't tell you when the oil price is going higher or if it's going higher, but I just have a sense that based on what I'm looking at, there's just so much pessimism and so much negativity that I want to take the other side. Maybe the bears are right. A lot of times the crowd can be right. Maybe we are going to go down to $50 a barrel. But at $50 a barrel, are you going to be drilling more wells in the Permian or less? You're going to drill less. So it's a self-repairing situation, regardless of what happens. Okay. So um, it doesn't matter if it goes down to 50. I just buy more shares because inevitably the mean reversion will be even greater. And in the meantime, I'm still getting share buybacks. I'm still getting dividends. I mean, I just can't, I don't think I can lose in this situation. So this is a guy that you should follow. He used to do this energy tidbits. He used to be affiliated with someone, I think a larger organization. Now he's off on his own, but he does a lot of these energy tidbits, a lot of good stuff. Basically, he was talking about some things he found in a recent talking about what Exxon said recently, and says global natural gas supply decline rate is 11% per year, says Exxon, i.e., need to add new production every year to offset the 11% decline rate just to keep production flat before meeting the 20% growth in demand per Reuters report flagged. Because this is from Exxon. In the absence of new investments starting today, global natural gas supply would decline at 11% per year, resulting in a shortfall of about 250 billion cubic feet per day by 2030, or about half of projected global demand. So again, we have not been investing enough. And so are we coming to a culmination point where this is going to start manifesting higher prices? Something to think about. So this is a chart that Eric Nuttall from 9 Point Partners put up with some data from Bloomberg. It shows the sub-indexes relative valuation matrix. Here's your 2025 consensus free cash flow yields. Here's the 2025 consensus enterprise value to EBITDA. And here's energy. Energy has sector has a basically 8% cash flow yield at 60% W or $60 WTI, and almost a 14% cash flow yield at $70 WTI. So somewhere we're in this here in this mid range, so we're somewhere between 10 and 12% free cash flow yield. Look at the other subsectors. I mean, they're just so overvalued relative to energy when you look at cash flow yield. And cash flow is what I care about, because what can you do with cash flow? This is cash that actually comes back to me via dividends and share buybacks. And that's what these companies are doing with their cash. And not out building. I've had this. I've talked about this many times. And so I'm willing to buy these crown jewel assets, get these cash flow streams, let them continue to buy back the stock. Hey, nobody wants to buy the stock, we'll buy it back. And then at some point, the worm turns and the price of oil and energy goes up. Energy comes back into favor, and we own a lot of shares very cheap. And I think that's exactly what's going to happen. So this is U.S. cities average electricity price in kilowatt hours. You see bouncing along here at around 14 cents a kilowatt hour till you get into this AI boom and you see what's happened. We're seeing pushback everywhere. I said as we're up here, choose between AI boom or cheap power. This is going to become a political situation. It's already becoming a political situation in Pennsylvania and other places. We talked about the PJM bidding for year ahead power, what the rates are going to be. And there simply is more demand than there is supply. And it's not just a matter of creating some more natural gas fired generation. You know, the antiquid, the antique, I should say, transmission and distribution is also a problem. You have to build substations. Well, we have shortages of transformers. We have shortages of labor. We have shortages of a lot of things because we don't have an industrial base here in the United States, because we ignored all of this for many, many years because we were content to financialize our economy and somebody else would just provide it. It was there. And so we're standing on the shoulders of giants again, didn't do maintenance, didn't do capital investment, didn't anticipate anything. And now we're sitting in a situation where we need the power to help facilitate the um, AI boom, if you will, in quotations, and you see what happens. And so this is why I think that this is going to become a political football. It's an opportunity also, obviously, but I think if prices keep going up for energy and electricity, people are going to start pushing back. Hey, wait a minute, you telling me my electric bill has went up several $100s, or several hundreds of dollars a year, or thousands of dollars a year, so that we can have Chat GPT version 5? No, people aren't going to go for it, and politicians will respond to that because we still do live in some kind of democracy, I guess, and people vote. And if they get riled up enough, they're already riled up enough. I've been talking about this inflation that we keep having, this inability of people to get ahead and make ends meet for the majority of the population is going to bubble over politically. And the party politicians that figure this out and get on top of it first, they they are the ones that are going to be able to get elected. Now, from the left, you're going to see, and part of the problem is you got to deal with this Federal Reserve. You got to fix the money. No one even talks about that. People just assume, well, this is the way it is. Prices are going up, and people have no idea. Well, it's greedy supermarkets. It's the greed of the electric utilities. No, a lot of it stems from the money creation, the central bank itself, the counterfeit that goes on. We don't have real money. Okay, we have the ability just to create money out of thin air. That's what happened during COVID, and people just don't understand this. And so, if you don't attack one of the root causes, the other cause is overspending because it's a manifestation, right? You overspend, so you have to borrow the money. You can't borrow the money, and so you go and monetize the debt. That's inevitably what happens. And so the resources, you're able to increase spending, but the resources in the economy don't increase at the same rate, hence prices go up. It's not hard to figure out, but there's not one person in 10,000 that understands this. And so it's very easy for populists or leftists to come along and say, well, we're going to regulate the grocery stores. We're going to put rent control on. These are band-aids. They won't work. They're band-aids on top of band-aids. But most people don't understand this. But again, this will be an opportunity for people that do understand it because it will lead to more inflation, more economic issues. This will be positive for gold and there'll be more money creation. And so you can see what's going to happen. So again, you've spent $1 trillion now on AI, and right now you have about 20 billion in revenue. Here's the top revenue getters for AI. OpenAI shows them all here. It doesn't work. You spent $1 trillion, and then these assets depreciate, right? Because you get better and better hardware as time goes on, and then you haven't been able to generate enough revenue to pay for the investments you've already made. You see, this isn't going to work. And so I think that this bubble is going to pop eventually, inevitably, for several reasons. I don't know what the exact pin will be. There's possible catalyst, the fact that they don't make any money or even aren't cash flow positive. We've seen this before in other things. We saw it during the tech wreck in the 98, 99, 2000. Saw it in the initial shale boom where it was throwing a bunch of money at it and the drilling wasn't even cash flow positive. So there were certain benefits for certain people. Yeah, we had lower oil prices, so that benefited the overall economy, but the investors didn't necessarily benefit, and the debt holders didn't benefit. So there will always be winners and losers. Places to. There will always be a bull market somewhere. Let's put it that way. So that's what we're trying to identify in the Actionable Intelligence Alert newsletter. But this is the bubble. This isn't going to work. I mean, $1 trillion is 1,000 billion. You see the problem, and you spend 1,000 billion for the hardware and for setting up this stuff, and you're only generating 20 billion in revenue. It's not going to work. At some point, these companies are going to run into problems. The shiny object will become dull, and then people will run away from it, and then it will implode. When is that going to happen? I don't know. So, um, Canada elbows up. They showed Trump, and they have the largest current account deficit. They have a record current account deficit now. And so, but hey, you showed Trump. Basically, it seems like, I don't know, I'm not from Canada, but it seems like a lot of people there just voted for Carney because he said he was going to be tough against Trump, and he hasn't. He folded up like a cheap suit because Canada needs the exports. We don't need their exports. Okay, that's the problem. And as a perfect example of that, Canada banned U.S. alcohol, I think, sales or something. And so the Crown Royal uh, factory or wherever it is in Canada is closing up, shutting down, and moving back to the United States. So there's consequences. And so but you showed Orange Man, and that was what was really important. My feeling, my feelings hurt by orange person must hurt orange person. And then what you did is you hurt yourself. Okay. And when you have problem is currently, whether people like it or not, we have a $30 trillion economy, and it's a consumer-based economy. I think it's a lot of Potemkin village and false and based on debt, but it is it's like a black hole. And so you have to deal with that. And you're a smaller economy and you're reliant on that economy for exports. You can't, you want to do elbows up and show, be prideful, you can do that. And I think it has consequences. And the economic conditions in Canada are not good right now, from what I'm understanding, and it's going to get worse. And so all these Western democracies are going to go down the tubes. They're just not financially viable, including the United States. People just cannot see it. And so there'll be more debt, there'll be more government programs, there'll be no more commissions, there'll be more nonsense instead of doing what's really required. Because that's not the mission of the politicians in the West. They're globalists and they have an agenda, and it's not the best interests of their people. It's the global project. One world global government run by technocrats that know how to push the buttons and pull the levers and turn the dials in the right sequence. And it's just not going to work. It's not working. And so this is just another manifestation of that. Carney was not really good at any of the jobs he's ever been in, and yet you guys voted him in. Well, good luck with that. And so here we have France now. The government's about to fall in France. People aren't paying attention to this. Faces catastrophic 2.85 trillion pound debt explosion. Might need a possible IMF bailout. France is facing a staggering $2.58 trillion or pound debt explosion and could soon be forced into the humiliation of an International Monetary Fund bailout as Emmanuel Macron's government teeters on the edge of collapse. Eric Lombard, the Minister of Economics and Finance, issued a stark warning that a risk exists that the IMF will be forced to bail out Paris. The revelation comes amid widespread predictions that the French government may be toppled in a matter of weeks after Prime Minister Francois Bayrou said he would seek a confidence vote in Parliament. The looming economic crisis comes as a humiliation for French President Emmanuel Macron, who once claimed that he was the Mozart of finance. The 47-year-old was seen making the most of his summer holidays just weeks ago, speeding around the Med on a jet ski. And so there's not going to be an IMF bailout of France. It's one thing to bail out Greece or Cyprus with the IMF. France is like the second largest economy in the EU. This is a problem, okay? And so what do I think is going to happen? Yeah, these countries are having financial problems, okay? They have all kinds of problems. I don't even want to get into politically. You're not going to bail them out with the IMF. It's impossible. Okay. And so what you're probably talking about is a crisis that the EU Central Bank will step in. They'll issue Euro bonds, and then the central bank will buy the Euro bonds. This is what I forecast happening. Well, John, the ECB, against this charter, it can't do that. Yeah, it's done it before. It'll do it again. It'll do whatever it needs to do to preserve the EU project, except to do the things that are necessary to fix these economies. Just decentralize from Brussels and go back to the individual nation states competing against each other. But that's not the project. The project is the United States of Europe. And so it's not going to work. It's not working. And so now we have France on the edge of needing an IMF bailout, which the IMF is not able to bail out France. Sorry, it's too big. And that means, but this maybe might be what the globalists in Brussels want, because this moves them closer to more control out of Brussels, issuing Euro bonds, having the ECB, more regulation, more control. That's good for the project, but it's not good for the economies. And the people are pushing back. They see it now. And if this goes, it'll go quick. It won't be the only country. Because last week we had a article, I think it was from the Sunday Telegraph. It was one of the papers that's still kind of like not a liberal rag, suggesting that the UK might need a IMF bailout because of their debt. Now they had a bailout back in the 70s. They had a IMF bailout in the 70s because they ran the liberals ran the economy onto the rocks. And it looks like they're doing that again. Successive conservative and liberal governments have uh, moved the ship into the shoals area. And so there was a whole bunch of articles. All the other, of course, statist establishment newspapers came out with editorials about why this wouldn't happen. Here's one of them. It says, "Don't fall for talk of the UK needing an IMF bailout. When they start denying it is when you should begin concerned. This is the first stage of heading towards needing a bailout." And so how's the IMF going to bail out France and the UK? It said when last week in a Sunday newspaper, I think it was the Sunday Telegraph, I can't remember. Anyways, reported on its front page, this is, I think is from The Guardian, this quote I'm getting here, that Rachel Reeves was heading for a 1976 style International Monetary Fund bailout, your reaction may have been, "This is worrying," or you might have thought, "Oh no, not the old chestnut again." It is not necessarily news to say that the UK is not going to have an IMF bailout. Every sensible economist, the establishment economists, who are usually not right about anything, it's my own ad here. Every sensible economist and everybody who knows the history of the 1976 episode would agree. Where there is a debate is about whether this government can ever fix the public finances. Some argue, while regarding an IMF rescue as implausible, that if the public finances are ever to be fixed, an external, omnipotent authority is needed to do that. The IMF imposed austerity as a condition of its rescue half a century ago. Conspiracy theorists even suggest the Treasury could engineer a crisis to bring such austerity about, or bizarrely, to steer us back to EU membership. That's exactly what Keir Starmer's trying to do. They want to get the UK back into the EU. That's the excuse that's going to be used when the finances in the UK blew up. We should have never left the EU. Let's re-enter the sinking ship of the EU. I mean, it doesn't matter what I think. The finances in the UK, France are horrible and they're going to get worse. So whether they need an IMF bailout and the whole Euro project is inevitably going to fail. It's that simple. It cannot last. It will not last. Let's go on to the next country. So we have the German welfare state can no longer be financed. This is from a German newspaper, according to Merz, the new chancellor. German Chancellor Friedrich Merz has called for a reform of Germany's social welfare spending while ruling out tax increases on medium-sized companies. Here's a quote from Chancellor Merz, the you know, wet noodle chancellor. He's not, the former BlackRock guy. The welfare state that we have today can no longer be financed with what we produce in the economy. Okay, let's stop right here. Why is that? Germany had one of the best economies ever for many, many years. And because of their stupid net zero policies, because of them allowing the UK and the US to blow up the Nord Stream pipeline, the forced deindustrialization of Germany, that's why you can't afford it. Okay? And so it's not viable anymore. And so we must make cuts, but no responsibility on any of these clowns that caused this. Merz has struggled to appeal to his base since coming into office, and his Saturday comments can be seen as a nod to the traditional CDU voter, as well as those former CDU voters who have turned to the far-right alternative for Germany. Yeah, I think Alice Wedel's even been saying recently that, it's time to get out of the EU. So again, we don't have enough money for the welfare state. It can no longer be financed with what we produce in the economy. But side note, Germany and Western allies sending military aid to Ukraine. Germany has plenty of money to send to Ukraine. They can't finance the welfare state anymore. Okay, cannot be financed, but we can finance the continued war in Ukraine. See, it has nothing to do with democracy in Ukraine. It has nothing to do about the Ukrainian people. It has nothing to do with this. It has to do with the EU project. They need that war because it gives them something that they can all coalesce around, a common enemy, the hobgoblin in the wood, the typical statist project. There's hobgoblins in those wood, and you need to have us, you know, super smart technocrats to help, and in order to do that, we need more EU. We need more coalescing around Brussels. We need more centralized authority. See how it works? And so Germany announced on Wednesday that it will work with a group of Ukraine's Western backers to supply a package of military aid to the war-ravaged country worth up to 500 million using a new NATO supply line. Germany has delivered or pledged military support to Ukraine worth around $47 billion since Russia launched its full-scale invasion in February 2022. So I asked my German listeners and those that are maybe pensioners or receive government benefits from the German welfare state, would you have preferred to save the welfare state and that 47 billion or fight those evil Russians that are on their way to take over Berlin again? You choose because you can't have both. Anyway, this is another thing. This is all leading another reason why I'm very bullish on gold going forward. This is going to lead to a tremendous amount of money printing. There's going to be, again, more political, economic, and social unrest, and volatility, and that's going to be positive, I think, for precious metals. So that's it for this week. Again, for those that are interested, I go in more depth into the reality check and a lot of these political things. I'm trying to not do that so much here, but I do think that we had a lot of news around three major countries in Europe that are all having financial issues that I think are going to get worse before they get better. So it was worth talking about. That's it for this week. Talk to you next week. Thank you.